Welcome back. We are now at Unit 2.9, Insurance Products and the Long-Term Insurance Act. In our next session, we will discuss premiums and risk. But a long-term insurance policy promises benefits based on some unknown future outcome. The unknown factors can be grouped broadly into demographic and economic unknown factors. Demographic unknown factors relate to the risk of living or dying, becoming disabled, sick, etc., while economic unknown relates to interest in inflation rates, investment returns, etc. Determining an appropriate price is not just finding an expected future outcome and determining the required premium for it, but rather modeling the risk. To try to understand the financial outcome of charging a given premium for a variety of possible future demographics and economic outcomes, as well as the sensitivity of the result of each of these variables. The process of determining a premium for a policy contract consists of setting assumptions. So you need to assume for example, interest rates or inflation rates, expense levels or mortality rates will be in future. You need to determine the product structure, for example, providing life insurance, disability insurance, premium waiver benefit, whatever else you want to add to that product. Determine the premium required to meet the required return on capital. For example, would 20 Rand per month be enough to cover the risk? If you want to cover R1 million risk, obviously you'll need much more than 20 Rand per month. Testing the sensitivity of the resulting profit to a wide variety of future outcomes. For example, what if the person died tomorrow? They gave you 500 Rand, million Rand cover, and you lost $1 million, you only received 500,000. What would be the impact on the life assurer? Right. Testing the sensitivity of resulting profits to a wide variety of future outcomes. For example, as I said, the person has died now tomorrow. What if he lives for the full term of the policy? So instead of dying tomorrow, he has now outlived the policy term and got to the end of the term. Then obviously in this scenario, you will have made a profit on that client. An analysis of actual past experiences or appropriate model of future experience is used to decide the initial assumptions. Right, there are a number of factors, of person-specific factors that result in different levels of risk and therefore, in theory, imply significantly different premiums. Now, the younger a person is, the better the tariffs can be, and the older the person is, there's more risk involved. Gender also do play a role. Income. If a person earns more money or less money, the less a person earns, the higher the risk. The more a person earns, the less the risk. Education levels. If a person is highly educated, they usually function in a more safer environment. If they are not highly educated and they are doing manual tasks where it's involved machinery and tools, it might be a more dangerous occupation. Right, occupation itself plays a role. Smoker status, do you or don't you smoke? Because smokers' risk is much higher for contracting certain illnesses. Geographical location, let's say you stay in a certain part of the country that is very prone to hurricanes, very prone to flooding, very prone to natural disasters, then obviously that location will bring a higher premium. Whereas you live in an area where there is less of these happening. HIV status and the progression of HIV, the health status and the medical history of a person. A healthy person obviously will need to pay less, and a person with certain health issues will obviously be loaded or pay more on his premium. And then hazardous pursuits or pastimes, like diving, skydiving, piloting, racing, all these do contribute to risk, on a person's life. Included in the premium are certain other running costs, and these costs involved, firstly, administrative costs, These are the costs that a company incurs in the administration of the policy. Commission-related costs, the insurance company will pay commissions to the agent or the broker who sold the policy to you as the policy owner. These costs are usually negotiated between the intermediary and the client and could involve upfront as well as ongoing fees. The cost of issuing a policy contract, the company will incur costs in issuing the policy, such as underwriting process and the issue of the policy document, and they're also going to pay stamp duty on their document. Management fees, if the policy has an investment component, the fund needs to be invested and managed by asset managers who will charge a fee based on the amount invested. Right, then your non-forfeiture clause, a policy with life cover will remain in force even if the premium payer did not pay premiums, as long as the policy has a cash value. This is achieved through the mechanism of non-forfeiture clause. The automatic non-forfeiture clause will be activated when a client with a policy with a cash value has not paid 2 or more premiums. The system automatically then pays the premiums from the policyholder's cash or surrender value. The premium will be advanced in the form of compound interest-bearing debt against the policy. Once the cash value has been depleted, the policy will then be surrendered or terminated. So they'll take money from the policy as long as there is a value in the policy. If there is no cash value for new or other policies, such as whole life policies, in those type of policy products when it's just been purchased, and or if whole life with no investment account linked to it, there is no cash values, thus there can be not a non-forfeiture clause on these policies. In these cases, the policy will lapse and the cover will fall away after there have been 2 unpaid premiums. Now again, take into account the client has made a lot of effort, gone through maybe medical requirements and so on to obtain the cover. He managed to get the cover, and now this happens and he's got to restart the process. So it's important that we also follow up with our clients and make sure they continue to pay their premiums. Then there's restrictions on life policies in terms of Section 54. This is to level the playing grounds between banks and insurance companies. In terms of this provision, a policy must run for a period of 5 years for the proceeds to be tax-free. This is called the restrictive period. Now, when I started in the industry, it was 10 years, and later on they brought it down to 5 years. However, if the premium is increased by more than 20% compared to premiums paid during the previous 2 premium periods, it will result in the policy entering a new restrictive period. I mean, it's as you now paid, let's say for a year and a half, 100 Rand, and now you want to double it to 200 Rand. That other 100 Rand can't now also be the same as the one that you've paid for a 2-year period, because now you're doubling up your amount that pays out in a tax-free format. I say tax-free format as there is tax payable on the investment in the policy. The restricted amounts will not apply under the following cases: on death of the owner of the policyholder, or if the owner of the policy is declared insolvent or his affairs have been placed under curatorship or judicial management. Right, let's look at an example. Tipo is a new client. He took out an endowment policy on the 1st of January 2007 with a recurring premium of 1,000 per month. In November, which is a year, which is in the same year still, he approached the financial advisor and requested that the premium is increased from 1,000 to 1,500 per month. As he is still in the first year of his investment, he can increase his premium without any restriction. However, if SIPO had decided on January of 2008, which is now a whole year later, to implement the increase, he would have exceeded the 20% rule in this instance. If he still went ahead with the premium increase, a new restrictive period of 5 years would start from the 1st of January of 2008 and only pay out 5 years later in a tax-free amount. All right, example, let's say premiums is paid in year 1 is 100,000 and premiums paid in year 2 is 120,000. An increase may not be more than 120,000 times 20%. Or in this case, 144,000. It's the 120 plus the 24,000, which is 20% of the 120. In total, in year 3, to prevent the policy for entering into a new restricted period. Right, on the next one, we look at anti-selection. Anti-selection is where the client chooses a product that is to his advantage, but which could be to the insurer's disadvantage. For example, where a company offers its staff additional voluntary life cover arrangement on a group rate, which is cheaper than the individual rate. The people who poses a higher risk than average are more likely then to take up this offer. For example, those who are in poorer health than their colleagues and who stand a higher chance of dying early. Another example is, consider a hypothetical scenario where an insurance company did not differentiate its premiums by smoker status, even though smoking significantly increases the risk. Perhaps the insurer set the premiums based on some mix of the smoker-non-smoker mortality. For example, assuming an average level of risk between smoker and smoker risks. In theory, all smokers would take this cover, as non-smoker would subsidize their premium, while the non-smokers would not take the cover, as they would be subsidizing. Most clients who are taking this cover would then be smokers, so the premiums should have been actually set according to the smoker risk only. A smoker taking this cover could then be said to be selecting against the insurer, or what we call anti-selection, because they now get it at a non-smoker rate. Right, underwriting, all risk benefits, for example, life, disability, dread disease, medical insurance, accidental death, and or disability and funeral benefits are subject to risk underwriting process. Once a client or a proposer has completed and submitted an application form to an insurer for any risk benefit, this is then passed on to the new business area at the business and then go to the underwriting area. The underwriting is the process of determining the level of risk that an individual poses to the insurer with which the individual is intending to contract. The insurer will then consider the various factors to determine and quantify the risk the company is willing to take on the individual's life assured. These factors will generally impact on individual eligibility of the insurance product and the nature of the benefits or the cover amount for which the proposer may qualify. The higher the risk an individual poses, the greater the cost that may need to be carried by the individual. The underwriter focuses on both the medical underwriting and non-medical underwriting factors in assessing the individual's risk. Medical underwriting. Medical underwriting is an insurance company's process to consider the risk related to the life assured state of health. If a person is assessed to pose a higher risk than his peers in this process, he may be required to pay a higher premium for the same level of cover. This they call a loading, which means that they increase your premium by the amount of risk that's added. Suppose the applicant poses a significant higher risk in a particular area, or in that case the insurer may even impose a health exclusion. For example, a person who has had a stroke may be excluded from any claims related to this condition. Or a person might have a heart condition from birth, and then they will exclude any thing related or any disability that will happen due to the heart. The following factors are taken into account when they calculate the risk premium. Age and entry. The younger you are, obviously, the better the premium. The gender of the person, their height and weight ratio. Are they smokers? Are they non-smokers? The HIV status. Do they have previous or have they got any current medical conditions that they are aware of? Right, non-disclosure. Non-disclosure is the failure of an applicant to provide or disclose information to the insurer The Act provides for the fact that the insurer can reject or reduce a claim if any material information was not disclosed or misrepresented that could have affected the insurer's assessment of the risk. However, no policy will be invalidated, nor will the obligation of the long-term insurers be excluded or limited, nor the obligation by the policyholder be increased by any misrepresentation unless the misrepresentation materially affects the assessment of the risk of the policy at the time of issue or the variation of the policy. Let's look at an example. The insurer cannot refuse to pay a disability claim when they discover that the client did not update his residential address, because that's a minor issue, it's not a major issue. Examples: the insurer could refuse a disability claim if the client were untruthful about the fact that he works as a pilot. That's at the time when the policy was taken out, he didn't tell the insurer. And this materially affects the risk of the assessment. Right, requirements for making or marketing long-term products. To make long-term insurance products available to the market, the provider, or the FSP in this case, has to be registered or deemed to be registered as a long-term insurer, be authorized, and in this case by the FSCA, to carry on the kind of business and has to carry on business in accordance with the Act. Now, when they are registered, they've got an FSP number that's issued by the FSCA, which then is displayed on their website and on their stationery. The Act lists offences in the schedule committed by either an insurer or someone else, which are subject to a maximum fine of 100,000 or 12 months imprisonment. That's for non-insurers only, both for certain presumably non-material offences, and a maximum fine of 1 million rand or 10 years imprisonment for more material transgressions. If the registrar does not receive information he requested within a certain period from a person, he can impose a fine of up to 1,000 rand for every day that the information is still outstanding, irrespective of any criminal proceedings instituted. The long-term insurance ombud. Policyholders normally complain directly to the insurer if unhappy with the decision or action taken or service rendered relating to any long-term insurance business. If the complainant has not been dealt with to the client's satisfaction, then the complaint may be addressed to the long-term insurance ombud for consideration. So you first need to go to the insurer, complain, and if you're not satisfied, then you can take the case to the long-term insurance ombud. If the complaint relates to the advice, the actions, the non-actions, or services provided by an intermediary, such as a broker or agent, then the complainant may lodge a written complaint to the intermediary concerned. If the complaint is not resolved to his satisfaction, the complaint can be directed to the Registrar for Long-Term Insurance or the Financial Sector Conduct Authority or the Financial Advisory Intermediary Act or the FASE Ombudsman. If the registrar or the ombud finds that there is a breach has taken place, he may, after informing the intermediary concerned of his findings and giving the intermediary a reasonable opportunity to respond, order corrective steps to be taken within a specific time. The registrar or the ombud may also take any steps in connection with a breach that are available in the law, including restitution. An intermediary who contravenes or fails to comply with the provision of the Act will also be guilty of an offence and or a conviction and can be liable to pay a fine not exceeding 100,000 or imprisonment for a period not exceeding 1 year, or both the 100,000 and the 1 year imprisonment. Like long-term insurance contracts, as with any other contract, an insurance contract or policy is concluded when the parties, the proposer or the client, and the insurer agrees to be bound by certain terms and conditions. The terms by which the parties agree to be bound basically revolves around the person insured, the risk insured against, amount payable by the insurer on the occurrence of the event insured against, or the maturity date reached for the investment policies, the amount of premiums payable by the insured, and the period of insurance. The terms of the insurance contract can be broadly classified as the term required for the contract to come into effect, for example, through statements, disclosures by the policyholder which resulted in material alteration in the risk, terms required for the contract to remain valid, for example, that the policyholder remains a South African resident and pays premium on every due date, and then terms also required at the claim stage, for example, that a claim must be submitted in writing on the insurer's prescribed form and with the relevant additional documentation. Fitting into this broad classification, the Long-Term Insurance Act prescribes specific terms that must be contained in the insurance contract, and these terms are as follows. The undertaking by the insurer to provide a policy benefit shall be suspended until the insurer has received the first or the only premium, or until arrangements to its satisfaction has been made for the provisions of the premium by debit order, stop order, credit card, or other instrument approved by the Commissioner. So until that premium hasn't been paid, there is no contract in place. Suppose a premium has not been paid on its due date. In that case, the insurer shall notify the policyholder of the non-payment, and the policy shall remain in force for a grace or prescribed grace period, which is a maximum of 1 month or 31 days, or such a more extended period as may be agreed between the parties. Suppose the overdue premium is not paid by the end of any such a period, in that case, the policy shall provide sufficient value and be paid up if there is value in the policy, or continue without further premium payments if there is value in the policy again. If there is not sufficient value in the policy, then the policy shall be surrendered or it will lapse, it will be cancelled. The insurer must then inform the policyholder of these events in writing, so the policyholder is now informed that he no longer has cover under the policy. Right. Fitting into this broad classification, the Long-Term Insurance Act prescribes specific terms that must be contained, and the following are some of the other terms that we need to add to the contract. In the case of the insurance contract, there are assistance policies. Either parties hereto may request that a policy benefit which is expressed otherwise than in a sum of money, for example, the provision of a funeral, shall be provided as a sum of money equal to the value to the cost of what they would have incurred had the non-monetary benefit been provided. The insurer shall not undertake to provide policy benefits that would exceed the 20% rule, referred to the section dealing with the consequence of increasing premiums by more than 20%. We discussed section 63 and 64 earlier. An insurer shall not undertake to provide benefits in the event of the death of an unborn or a minor before the age of 14, where the value in the case of an unborn or a minor under the age of 6 is more than 20,000, or B, in the case of a minor older than 6 but still under the age of 14 is more than 50,000. But long-term insurance contracts, the following terms shall not be enforceable by an insurer if they are contained in an insurance contract. The insurer is not responsible for the actions or statements of its representatives about the insurance contract. So this wasn't in the contract, but the representative has promised certain facts, which is not in the contract. An admission by a policyholder that the insurer's representative was appointed to act upon his behalf. If a policyholder waives any rights that he may have under the legislation. Also, an insurer shall not refuse to enter into an insurance contract with a person rendering military service by the Defence Act 1957, Act number 4 of 1957. A minor who has attained the age of 18 may, without the consent of his guardian, enter into or vary or deal with an insurance contract under which he is the life assured and pay the premiums due under the policy with money he has earned or which at his disposal, and a policy benefit under the policy shall be provided to the minor, who may deal with it as he thinks fit without the consent of his guardian or his parents. An insurer may not cancel an insurance contract on any wrong statement made by a policyholder if such statement do not materially affect the risk under the contract. Benefits may, however, be adjusted to the correct age where the age was wrongly given. An insurer may not cancel an insurance contract merely because a provision of any law has been broken. An insurance contract may, however, be cancelled where the policyholder misrepresented material facts in the contract. An insurance contract issued by an insurer who is not allowed to do so or by a person who is not an insurer shall not be valid, and the policyholder shall be in the same legal position as when a breach of contract was conducted by such an insurer or person acting as an insurer. Any insurance contract entered into before or the commencement of the Long-Term Insurance Act, which does not comply with any provisions of this Act, shall not be void or unlawfully merely because of this fact. But commission payments. The Long-Term Insurance Act also restricts the amount of commissions payable to an intermediary for placing a long-term insurance business. Changes are made to these limits from time to time. I also see the amendments to the Long-Term Insurance Act effectively from the 1st of January 2018. Commission tables in Annexure A and Annexure 2 includes the following changes. The amended commission tables remove commissions of 22.5% for credit and credit life schemes with administrative work as from the 1st of January of 2019. A 7.5% commission cap for credit and credit life schemes is applied so as to give effect to proposal AAA of the RDR. RDR stands for Retail Distribution Review. The FSCA's rationale is that administrative work carried out by the intermediary that falls outside the scope of commissionable service as intermediaries should be remunerated through other means. For example, permissible outsourcing fees or binder fees or as appropriate. The Scale A for normal commission for group schemes and fund policies has new thresholds ranging from 7.5% for annualized premiums not exceeding 200,000, which was previously 142,000, to 1% for annualized premiums above 2 million, which previously was 1.55 million. Remuneration for binder holders. The long-threatened regulation relating to the remuneration of binder holders and intermediary has appeared. The general principle required that all binder remuneration must be reasonable and commensurate with the actual cost of performing the binder function, taking into account the nature of the function and the resources, skill and competence reasonably required to perform the binder function. Must not result in double counting. Conflicts or potential conflicts with policyholder interests must be effectively mitigated. Payment must not impede the delivery of fair outcomes to policyholders, which is an impossible subject test, but the intention is apparently to prohibit excessive remuneration at the cost of clients' benefits. The remuneration for a non-standard intermediary, not an underwriting manager nor an administrative FSP, who is a binder holder authorized to advise under the Phase Act or an associate of such an NMI, is a maximum of 9%. Up of, there is no fee at all for payments who only determines wording, premiums and benefits. 5% for entering into, varying or renewing policies coupled with on one or more functions or determining policy wordings, premiums and benefits, but limited to 3.5% of the NMI, only enters into or varies or renews the policies, and 4% for settling claims. Underwriting managers and administrators, FSPs, can still share profits attributable to the policy referred to in the agreement. An NMI who has entered into a sales structure arrangement with an insurer can receive dividends regarding the share held. If the NMI does not give advice, their remuneration is only subject to the general principle in paragraph 2 above. Still, it is difficult to see how you would justify more than 3.5% for entering, varying or renewing a policy if no advice is given, save in exceptional cases. The binder fee of the non-mandated intermediaries but not on underwriting managers must be disclosed to policyholders by the binder holder, and the disclosure must be required in terms of the binder agreement. There is no requirements to disclose profit share or sell arrangement dividends. There are changes to the remuneration for intermediary services relating to investment policies that commenced on the 1st of January 2009, and changes to the intermediary remuneration for other policies. And the Commission regulations for policies other than investment policies, here called risk policies, make several changes that will have to be looked at carefully by long-term insurers. We do not intend to make a detailed analysis here. We're only highlighting some of the significant issues. The definition of an administrative work will be deleted as from the 1st of January 2019. The Commission is now due on premiums payable and no longer on premiums payable and received, but clawback provisions remain. There are extensive new provisions regarding replacement investment policies and replacement risk policies, including defined replacement investment events and casual events. A new Part 5C contains the principles for calculating casual event charges. The regulations now deal separately with replacement risk policies and replacement investment policies. The special provisions concerning the replacement risk policies cross-refer to the provision in a connection in the amendment policy protection rules. The definition of a representative limits the rights of an employee of one insurer to sell the products of another insurer, except for a class of policy which its employee or employer or mandatory does not underwrite, or classes or types of policies determined by the Commissioner. The representative may, however, continue to perform intermediary services about a policy rendered into before 1 January 2018 in terms of a written agreement with the other insurer concluded before the 1st of January of 2017. The Commission tables in Annexure 1 and Annexure 2 includes the following changes. The amendment of Commission tables removes the Commission of 22.2% for credit and credit life schemes. 7.5 Commission for credit and credit life schemes is applied to effect the proposals of AAA and RDR. The Scale A for standard commission and group schemes fund policies as new thresholds, and the maximum once-off special commission for group schemes and fund policies is now 7,500. That previously was only 5,000. This slide, I'll just recap the previous piece for you. Equivalence of reward. The new provisions of what is equivalence reward are more uncertain than ever. Equivalence can be determined by the Commissioner by notice on the FSCA website, whether any particular form of remuneration or consideration complies or does not comply with the principle. That is an impressible delegation of authority because no provision is made for public consultation, nor are there any parameters set, nor is it set when the determination will apply. Notification of arrangements with independent intermediaries and representatives. Suppose an insurer pays an intermediary or a representative an amount for a function or activity that, in his opinion, does not constitute the rendering of services as an intermediary or a binder function. In that case, the Commissioner must be notified in writing at least 30 days before the insurer enters into the agreement. The format of that notification is to be determined by the Commissioner. Associate. The definition of an associate concerning a mandated intermediary with whom any NMI may not conduct business, or a mandate or non-mandated intermediary with whom the underwriting manager may not conduct business, has been expanded. In addition to the phased definition of associate, the binder holder will be an associate of a juristic person that shares a significant owner or member of the governing body, for example, a board member or trustee, in any other juristic person whose significant owner alternative governing body is an associate under the Phase Act of a significant owner or member of the intermediary concerned. The significant owner is extensively defined by generally relates to a 15% threshold for shareholding, control, disposal of shares and board appointments. For this purpose, the definition of juristic person has been expanded to include companies, close corporations, cooperatives, trusts, a cooperative association, a partnership, and extraordinarily a club or any other body or person of whatever description, even if unincorporated, which is probably too vague to be enforceable. Who is an underwriting manager? The definition of underwriting manager has been expanded to include anyone having a legal relationship with the insurer, for example, secondment of employees of outsourcing of infrastructure like a call center, whereby the underwriting manager's employees are effectively entering into varying or renewing policies for the insurer. A binder agreement, a binder holder may only be a non-mandated intermediary, underwriting manager, or an administrative FSP. An insurer may only enter into a binder agreement if doing so will promote the delivery of fair outcomes to customers and will not result in the duplication of administrative efforts and costs, otherwise impede the insurer's ability to identify, assess, manage or report on the risks of poor customer outcomes. Transparency and effectiveness of oversight are therefore very essential. Binder arrangements, significant governance and oversight obligations are placed on the insurer, who must have the necessary resources and ability to comply before and at all times after entering into a binder arrangement with an insurer, and must identify, assess, manage and report on the risks of poor customer outcomes, ensure the adequacy of the binder holder's governance, risk management and internal control framework and ability to comply with appropriate laws and binder agreements, ensure the fitness and propriety of these binder holders, including any specific technical expertise requirements to perform the binder functions, ensure the validity, the accuracy, the completeness and security of any information provided by the binder holder, ensure that the binder holder has the operational ability to achieve integrations between the insurer and the binder holder's IT system so that the insurer has access to up-to-date, accurate and complete data held by the binder holder, and when requested by the insurer and when required by the binder agreement or by the regulations relating to data arrangement and management, including the policy protection rules. The insurer is obliged to regularly review the performance of the binder holder and assess the appropriateness and suitability of binder functions in delivering fair outcomes to policyholders. The insurer must implement appropriate contingency plans to address any shortcomings in the binder agreement and performance of outcomes to policyholders. Therefore, the insurer is the overseer of the conduct of binder agreements and is accountable to the commissioner for the failure of their binder holder as to the performance and integrity. An underwriting manager for a long-term insurer is entitled to conduct business with a representative, a person employed by and or with a mandate from or of a mandated or non-mandated intermediary who is a natural person. It is a significant change because it means underwriting managers can, on behalf of the insurer, conduct business with natural persons who are representatives or agents of the insurer, as well as employees of other intermediaries, to sell policies on behalf of the insurer for the benefit of the underwriting manager's portfolios. The additional immediate requirements for binder agreements are the requirement for non-mandated intermediaries, non-underwriting managers to disclose binder fees to policyholders, the governance and the oversight requirements, ongoing requirements to ensure that the binder holder is fit and proper, given the insurer the right of access to any data held by the binder holder when requested by the insurer, a right to take prompt and reasonable steps to rectify any non-adherence to the binder agreement. Latter requirements for binder agreements from 1 January 2020, binder holders will have to provide the insurer with an up-to-date, accurate and complete data for funeral and assistance policies every month and all other policies daily to enable insurers to comply with the data management and reporting requirements and with the policyholder protection rules. Insurers will have to ensure that binder holders have the operational ability to comply. For this purpose, the funeral policy is a life policy where the benefits relate only to the service or the costs associated with the funerals. The commencement of this, the amendment to the regulations take effect on the 1st of January 2018, except where the definition of administrative work is only deleted from the 1st of January 2019. The special provisions regarding the replacement of risk policies take effect from the 1st of July 2018. The Commission changes regarding term cover takes effect on the 1st of January 2019. The provisions regarding the maximum 9% binder remuneration for non-mandated intermediaries not authorized to render advice, including exemption provisions, take effect from 1 January 2018 for any new binder agreements, from 1 January 2018 for a binder agreement entered into between 1 January 2017 and 31st of December of 2017, unless the remuneration is amended in the meantime, and from 1 January 2019 for binder agreements entered into before 1 January 2017, unless the remuneration is amended in the meantime. Latter agreements for the binder agreement continue. For the purpose of funeral policies, the life policy, where the benefits relate to the services or other costs associated with funerals, and the commencement for this requirement, the requirement that the insurer must, before entering into a binder agreement, be satisfied that the binder holder has the appropriate ability and IT systems to provide access to data, and when requested will come into force as from the 1st of January 2020. The binder holder must provide accurate and complete data every month for funeral business and assistance policies, and daily for all other policies that came into force on the 1st of January 2020. Now that concludes this session. It was a rather lengthy session on premiums and risks, and we've also discussed the binder holder and binder agreements. We will see you then in our next session, which will be Unit 2.10. The impact of legislation on life policies will be discussed in our next session. Thank you for attending. See you then later.